Today I'll be sharing our team's work on effective computing in China's options market, 2016 to 2025, from Guangdong University of Foreign Studies, China. We've been exploring how investor sentiment analysis might offer new perspectives for trading strategies in China's unique options environment. While this is still work in progress, we're excited to share some preliminary findings that may contribute to the broader discussion on behavioral finance applications in emerging markets. This work presents our research on effective computing in China's options market. We address a critical challenge, traders' emotional paradox, confusion between fear and greed during high volatility, which disrupts buy-sell decision. Our solution is the Confusion Quotient Index. CQ quantifies fear-greed as the ratio of weighted put open interest to call open interest. Analyzing 2089 days of SSC 50 ETF data, we found when CQ is greater than 1, fear dominates, signaling irrational panic. When CQ is less than 1, greed dominates, reflecting short-term over-optimism. For 94 experiments, CQ proved effective in decoding emotional biases. This tool helps traders navigate paradoxes, enhancing decision-making in China's options market. Let's explore how. Here is the table of contents, which I will present in 6 sections. Why do options traders freeze? Our research traces this to a cognitive breakdown, much like the famous ambiguous sentence, "The horse raced past the barn fell," that causes mental gridlock. In trading, this manifests when fear and greed collide during market reversals. China's options market, launched in 2015, is especially vulnerable due to its volatility. While the US benefits from established sentiment indices, we explore how effective computing can be adapted for China's unique market dynamic. To address this, we apply the CQ index, a proven fear divided by greed metric based on put divided by call open interest, to China's market. It identifies emotional tipping points before cognitive breakdowns occur. Over 6 sections. Section 1, model sentiment price links. Section 2, adapt the CQ framework to China's context. Sections 3 to 4, validated through 94 experiments on 2089 trading days, and sections 5 to 6 derive practical implications from China-US comparisons. Effective computing integrates 2 core dimensions: physiological emotion recognition, such as facial expressions or vocal tremors, and opinion-based sentiment analysis from textual data like investor commentary. The field builds upon Plotchik's wheel of emotions, which classifies human affect into 8 primary types, later refined by Gemeyer into a quantifiable 3-axis framework measuring arousal, pleasure, and dominance in trading behavior. In financial markets, Li et al. Demonstrated dynamic correlations between emotional attention and stock price fluctuations. Specifically, greed drives investors to aggressively accumulate call options, chasing exponential gains. Fear triggers panic stacking of put options as crash protection. Neutral sentiment fuels capital preservation, exacerbating liquidity. Volatility. Addressing China's options market, launched in 2015 with distinctive volatility patterns. We leveraged the established CQ index. Using 2089 trading days of SSC 50 ETF data, our work delivers 3 key advances. Firstly, quantifying the abstract paradox, translating emotional chaos into a measurable metric. Secondly, China-specific validation, creating the first assessment benchmark for local markets. Thirdly, predictive superiority, demonstrating CQ's early warning capability, where traditional models fail during extreme sentiment phases. Next, we'll unpack the methodology and experimental validation. Our methodology anchors on China's flagship SSC 50 ETF options, averaging 1.58 million daily contracts. The CQ index quantifies fear divided by greed through weighted open interest. Sum WP for puts divided by sum WC for calls, weighted by option premiums, reflecting profit likelihood. Let's take March 2025 data as an example. Approximately 175,000 for the total weighted calls, 325 contracts, versus 153,000 for the puts, 325 contracts. The resulting CQ ratio of about 0.87, below 1, clearly indicated greed-driven bullish dominance, corroborated by the underlying asset's closing price of 2.68. We validate predictive power through z-scores. Analyzing 264 trading days revealed a striking correlation. The correlation coefficient between z-price and zCQ equals negative 0.9066. This inverse relationship means price surges correlate with plunging CQ, greed, while dips spike, CQ, fear. Our 5-step framework converts this insight into action. Step 1. Mine sentiment data. Step 2. Compute CQ and z-scores. Step 3. Extract market features. Step 4. Aggregate correlations. Step 5. Execute predictions using CQ threshold. Next, experimental results. We conducted a rigorous 9-year validation of the CQ index using real trading data from China's SSV 50 ETF option. Our experiment spanned 2,089 days, processed through 94 rolling 22-day modules, each dynamically updating z-scores for price and sentiment. With fixed monthly capital of 50,000, we executed CQ-guided trades once per month. Key questions focused on success rate, profit amplification under 10x leverage, signal duration, and emotion price predictive links. Next, we reveal how emotion translates to profit. Results confirm CQ's predictive power. 78.7% of trades were profitable, statistically significant per chi-square test. Under 10 times leverage, profits followed the absolute value of end price minus start price divided by start price scaling. For example, a 1% price move yielded 10% return. Signals remained valid 4 to 10 days, D greater than 0 for calls, D less than 0 for puts. Critically, the negative 0.9066 z-score correlation proves emotion drives prices, greed lowers CQ during rallies, fear spikes it during sell-offs. This resolves the fear-greed paradox in Chinese option. Our 9-year data reveals how macro events shape fear divided by greed cycles. During 2018's US-China trade war, put options averaged 64% returns as fear dominated. Conversely, 2020's Fed Q ignited call option rallies, peaking at 164% when hot money flooded Chinese market. CQ index consistently anticipated shifts. When the Fed cut rates in September 24, zCQ detected greed 3 days before prices surged, enabling a 143% call option gain. This predictive edge, visible in all 11 major events, proves sentiment leads price. Z-score dynamics unlock CQ's predictive power. When Z price is less than 0 and zCQ is greater than 0, red zone, fear dominates, yielding put profits like 2022's 117% gain. Conversely, Z price is greater than 0 and zCQ is less than 0, green zone, signals greed-driven call opportunities, exemplified by 2024's 143% return. Critically, zCQ turned before price and 89% of reversals, leveraging China's rate differential sensitivity. When USD and I spreads widened, hot money flows triggered predictable rallies, making CQ a geopolitical risk barometer. China's market is uniquely challenging. 99.76% retail investors drive extreme volatility, yet only 0.3% dare trade options due to leverage fear. Our CQ index cuts through this paradox, delivering 78.7% success rate over 94 experiments, statistically significant at p less than 0.05. Critically, it offers strategic neutrality, equal profit potential in bull-bear markets, 51 call versus 43 put wins, with gains lasting 11 days in rallies and 10 days in sell-off. This solves Cohen's warning that most options investors fail within 2 years. CQ thrives in China precisely because of retail dominance. The herd effect creates clean sentiment waves, unlike stable markets where eyes chartcraft excel. Our weighted open interest approach captures 99.76% retail activity, while eyes misses short-term panic moves. This avoided 76% of loss-making trades in chaotic periods. Our 9-year study proves the CQ index delivers 78.7% success in China's volatile SSV 50 ETF market. It outperforms qualitative tools like Cohen's OVI by transforming sentiment into actionable Z-scores, with emotion shifts preceding price moves 89% of time. For sustainability, we show monthly trading maximizes gains while controlling leverage risk. Looking ahead, we'll expand to other Chinese ETFs and global markets, integrating macro factors to build a universal effective trading framework. Thank you for your attention. It's been a privilege to share our research on effective computing in China's options market. Thank you.